Hi, this is your captain speaking with an important message for my clients who have a variable rate mortgage. I've made this video to let you know that we may be flying into some turbulence. And although I do not think it would come into play for some of you until September, I still want to give you the heads up today so that you already know about it well before your lender should ever contact you and you've already taken some action. For the record, I am still a huge fan of the variable or adjustable rate mortgage for the same basic reasons as always. Number one, people who have chosen these have historically benefited from lower rates than fixed rate mortgages, and this is still the case now despite the most recent hike in the prime rate. Number two, the penalty for breaking a variable or adjustable is typically way lower than for a fixed, and I recently published a different video showing how big the difference can be. Number three, if you ever want or need to, you can always convert your variable or adjustable into a fixed simply by contacting your lender. There's no penalty or cost. And the final feature of what differentiates a variable rate mortgage from an adjustable rate mortgage is that with the variable, your mortgage payments are static. And what that means is that unlike an adjustable, where your payments fluctuate with the prime rate, your payments on a variable do not change, regardless of whether the prime rate goes up or down. So a variable has all of the attributes of an adjustable while also having payments that feel like a fixed. And not only is it still my mortgage product of choice, but the vast majority of such mortgages offered at major banks and credit unions are variable, not adjustable. So again, how do you know whether you have a variable or adjustable rate mortgage? It's simple. If your mortgage payments have gone down or up over the past 2 years with prime, you have an adjustable. If your payments have not changed at all, you have a variable. And the way this is accomplished with a variable is that as prime rate changes, so does the mixture or blend of principal and interest that comprises that static payment. When prime goes down, you are paying less interest and paying more principal, and therefore you're paying down your mortgage faster using the same given payment. And when prime goes up, it's the opposite. You are paying more interest and paying down less principal, and therefore you're paying down your mortgage slower, or in other words, the amortization of your mortgage is being lengthened. And this brings me to the reason for today's video, and that is the trigger rate, also known as the threshold rate. So, what is the trigger rate? Well, if the prime rate should ever get high enough for your variable mortgage to hit its trigger rate, it means that you're at a rate where two things are beginning to happen. First of all, when you hit the trigger rate itself, then the mortgage payment you are making is now 100% interest. You're not paying down any principal. Now, if you're exactly at or just below your trigger rate, you should have no problems with your lender because you're at least making a payment that covers all the interest that's due during that payment period. And as with lines of credit, lenders are typically okay with interest-only payments. That being said, if your mortgage rate ever goes over its trigger rate, then that static monthly payment you are making is not only 100% interest, but technically, it's also not big enough to cover all of the interest that's due and payable for the month. And any interest that's not covered by your monthly payment is called deferred interest. And that deferred interest is added to the amount you owe on your mortgage month over month. And so now you're at a spot where your mortgage balance is not going down, it's not going sideways, but it's going up. This is called negative amortization, and lenders generally don't like it. There also comes a point beyond the trigger rate, which TD calls the trigger point. And there's a paragraph in your paperwork that describes that too. I'll point you towards that paperwork shortly. Basically, the trigger point is when your lender, in their discretion, can contact you when you are past your trigger rate and you've been negatively amortizing, and they want to compel you now to get your mortgage repayment back on track. And they offer you 3 ways to remedy these things. Number 1, you could make a lump sum payment to pay down the balance. Number 2, the most popular option is you can increase your mortgage payment. Or number 3, you can convert your variable mortgage into a fixed rate mortgage at fixed rates and terms that are available from the lender at that time. So now that you know what a trigger rate is, how do you find out what your trigger rate is? There are two ways. First, you can dig up the paperwork that you signed with your lawyer or notary when you got the mortgage. If you can't find it, just ask them, lawyer or notary, to try and dig it up at their office. Second, you can contact your mortgage lender directly and ask them. If you have already modified your mortgage by increasing your payments in the past, you'll want to contact your lender for an updated figure over and above the document. In the case of TD Bank, and this is for the majority of my clients, the document you're looking for is called the Mortgage Loan Agreement, or MLA. Please note that you did not get this document from me or my team. It was a formal document that you signed in front of your lawyer or notary at the end. I happen to have a copy on hand. What you see here is a redacted snapshot of the first page, and what you're looking for deeper in the document is 2 paragraphs. Here's the one telling you what your trigger rate is, and here's the one explaining your options if you arrive at the trigger point. Feel free to pause and rewind the video if it helps you find the sections in your document. So now that you have a basic understanding of what the trigger rate and trigger point is for your variable rate mortgage, I have a flight plan for you. Number 1, find out what your trigger rate is and make a note of it. Number 2, think about what you might do to remedy the situation if you should arrive at a trigger point. And number 3, think about what you may be able to do today preemptively. For example, it may be time to increase your mortgage payment effective now. Review your household budget and take action accordingly. With your flight plan in hand, I have armed you with some awareness and understanding. And here's a few extra points. First, why is this happening? Well, your prime rate has been increasing dramatically this year because of the Bank of Canada's goal to stifle inflation, which you've heard about in the news. We've seen some unprecedented moves this summer in prime rate accordingly. And speaking of unprecedented, many Canadian borrowers secured variable rate mortgages over the last 2 years at a time when both the prime rate and the discounts available to prime on variable mortgages were at all-time lows. This resulted in your static payment being set on day 1 at a very low level, and it may now be the case that the payment is too low. Okay, and second, when might trigger rates happen? Well, the next time the Bank of Canada is scheduled to review rates that influence prime is Wednesday, September the 7th, so please diarize this. And I estimate that if prime is increased again, then certain borrowers who originally had ultra-low variable rates and payments may then approach or surpass their trigger rates. Speaking of when will this be over? Well, it's too hard to forecast right now, and I won't hazard a guess. This is all being driven by the battle against inflation, and while I am not an economist, my guess is that a normalizing supply chain and more peace in Europe may help cool things off. And flip side, the very act of raising rates might result in an economic turndown or recession, which in of itself may push rates back down. And speaking of down, don't forget how quickly prime dropped during COVID, 1.5% in 5 weeks. This is why I still say, stay variable, my friends. Final point, what do I do about it? Stick to your flight plan. 1, find out your trigger rate and plan to take action. 2, stay calm. Don't let headlines freak you out. Explore your options objectively. And finally, reach out to me for help. If you're thinking about budgeting a payment increase or even converting into a fix, let me help you unpack each scenario. That concludes my little presentation. I hope it was informative, and I look forward to chatting with you about it if you have any questions. For now, please enjoy your summer, and again, stay calm, reach out anytime. Cheers.